I suspect that as children, many of us invested quite heavily in sweets. So tonight I'm going to talk to you about sweets. Let me take you back to when you were a child and you were taken to the sweet shop. Can you recall the thrill of walking into the shop? Can you remember the colors, the smells? Can you taste the sugar? In my day, sweet shops only offered about 6 varieties of treats. But boy, did those 6 jars represent a huge amount of possibility to me. I looked at them and was both excited and torn by which to pick. My taste buds already salivating at the thought. Well, for those of us who are involved in discretionary portfolio management, your discretionary portfolio management, selecting which investments should underlie a particular strategy can sometimes feel a little bit like walking into a sweet shop. The possibilities are endless and, quite frankly, very fascinating. As global managers with a mixed asset portfolio, we can invest in equity, in property, in bonds, in cash, and even in so-called alternatives. Let's consider property for a minute. If we decide to populate a portion of your portfolio in property, we could invest in what type of property could we invest in is the question, really. And where should that property be located? Do we buy commercial property? Do we invest in shared living accommodation? Do we buy warehouses? And if so, what vehicle do we use to access those investments? Do we use a so-called bricks and mortar fund with physical property underlying it? Or do we invest via a fund that has shares in companies which have exposure to real estate? Or consider equity. Do we invest the bulk of your equity exposure in single company shares that we have thoroughly researched? Or do we just buy the FTSE 100? Or do we widen our view to consider global investment markets and populate your portfolio with companies based in Japan, Canada, emerging markets? And if so, which vehicles do we use to access those markets? Do we use passive investment vehicles, index trackers? Or do we select investment managers with a foot on the ground and the required expertise to make the decisions for us? And finally, if we have looked abroad and not just concentrated on the UK, how do we provide you with the exposure that we believe is optimal whilst limiting your currency downside? If your base currency is sterling, how do we remove the currency exposure while still exposing you to foreign markets? In the past, the array of investment vehicles open to us was limited, a little bit like the sweet shop back in my day with the 6 jars. Now, though, the walls of choice are full with varying investments and vehicles through which to access them. We have widened our lens to include global financial markets with varying degrees of regulation, transparency, and risk. Unlike the sweet shop scenario, not all investment jars are filled with nice outcomes. Some are quite literally toxic. So how do we provide you with the required exposures and the opportunity that we see without taking a bite out of the poisoned apple? Some would shroud the answer to this very important investment question in complexity. But perhaps the answer is actually quite simple. At Nedbank Private Wealth, we adopt a series of investment principles. These are our foundations. They form the quality control for the ingredients that will go into your portfolios, and they are unshakable. Today, I'm going to talk you through 5 of our investment principles. The first principle is that we only invest in things that we understand. We don't invest in anything which we don't understand or which we cannot value. We have predominantly a funded approach to investing, which means that we invest via collective investment vehicles. And when we interview the fund managers that we've shortlisted out of the entire universe of fund managers out there, we require full transparency of their portfolios, their teams, and their end-to-end decision-making process. For us, this is vitally important because we need to judge the validity and the repeatability of their track record. For us, this would exclude investing in hedge funds because as opaque vehicles, they wouldn't share their intellectual property with us. So we wouldn't understand the potential downside for you. The second principle is liquidity. When things go wrong in the world of investing, liquidity, or the lack of it, quite often forms part of the consideration. I talked about a huge array of choices before in the sweet shop scenario. Each of those choices that we saw in those jars has a varying liquidity profile. As private investors, you could decide to purchase a second home or a buy-to-let. That would have a lower liquidity profile than, say, if we invested in company shares which are exposed to real estate. We would normally opt to flood your portfolios with liquidity. The rationale is simple. We might want to sell for a whole variety of reasons. We might have identified a better opportunity. We might want to risk mitigate, or we might want to profit take following a substantial rise. The third principle surrounds value and costs. The price that we pay for an investment and the costs associated with it have a direct impact on your net returns. We use low-cost passive investment vehicles when we believe that an active fund manager wouldn't have the opportunity to significantly add value over time. But costs don't always have the final say over whether an investment will make the shortlist. In our alternatives part of our portfolio, for instance, the costs are a little bit higher than for our equity and bond exposure. However, they have provided significant net of fee returns for our investors, as well as acting as a cushion in times of market turbulence. We firmly believe that they are a price worth paying. The fourth principle is diversification. The world offers a huge array of opportunity. We don't limit your pick and mix options to UK equities and bonds. We diversify across asset classes. We diversify globally. We diversify across sectors. If we have some conviction on a specific market, we will place a limited amount of risk on that conviction, whilst always ensuring that your portfolio remains diversified. Many moons ago, when I was studying, I was taught that a diversified portfolio was comprised of 20 stocks. We literally have thousands of companies underlying our portfolios. I was also taught that a globally diversified portfolio had at least a 20% exposure to global stocks. We don't have a UK bias. We invest globally because opportunity is everywhere. The fifth principle is to keep our eye on the long term instead of heeding to short-term noise. And we would suggest that you, as investors, do the same. Did you know that the average holding period for a stock has gone down from 8 years and 4 months in the 60s to just 8 months now. And this, despite the fact that we hear time and time again that one should invest for the long term. It's hard to predict the short term in markets, whilst one can be fairly confident about the medium to long term. Additionally, your objectives are probably longer than 8 months. So by adopting a long-term approach, we can match our strategy to your and your family's objectives. One of the benefits of appointing a discretionary investment manager is that you can effectively remove the risks associated with investing, thus avoiding the typical buy highs when you think that a rising market is going to last forever, and selling lows when you think that the world is surely about to collapse. Although we have short-term targets to profit take on market highs and buy more on market lows, we have a disciplined and rigorous approach which allows us to consider the short-term noise in markets whilst keeping our eye firmly fixed on your long-term objectives. When one of our private bankers or wealth planners sits down with you to assess your family goals and aspirations, if they recommend one of our discretionary investment strategies, these 5 principles will lie at the heart of it. Today, I have shared a conviction-driven 5-point approach to investing. The result will be a portfolio of predictable returns, where we offer worldwide opportunity whilst being firmly in control of the risks. As our track record demonstrates, the long-term outcome should be sweet.